not worth the points. It's better just to buy the paper, but
Right.
also understanding how do you make sure that that's good paper, that rehab bid is right, that those procedures are right, that all of those little factors that I mentioned as far as the risks that are obviously crazy concerning if you're not knowing what you're doing
Yep.
on that side or don't know the detailed due diligence on these things. That has to be looked at. So, and I don't like going to the public. We did it wrong in the beginning where we were like, great, I'll give somebody 100% purchase and rehab, up to 70% loan to value because I'm protected on my equity. But then you start finding a bunch of people that don't have any money and don't have any backup money. And then they start defaulting and you're going, well, yeah, because I'm targeting the wrong people, and you want
Yeah.
to target the people that are looking at value in a strategic long-term relationship that have experience, not the new people that don't have that or don't have enough cash to be able to
Yep.
put that together, right? So,
Makes
Yeah,
sense.
exactly.
So
Hmm.
me and Ethan are all for buying this debt paper, right? That's our market. We all want to stay in our lanes, right? An idea of, letting people originate paper, let them stay in their lane, let them originate, and we can buy all the paper that you guys create. I know we have a lot of originators, sub two people, wrap people, silver finance people listening and going, I'm making a ton of money on my, money up front, my points, all that stuff, which is wonderful. And that's great. We just don't want to do the hassle of having to go find that asset,
yeah.
right? One, two, if you're creating 10, 15 a month, that's a lot of work.
Oh, yeah,
We
it's
just want to
huge.
recapitalize in the same situation.
Right.
So you're basically buying your own paper at par, right?
Hmm.
Because you know the paper being good,
Hmm.
right?
Correct.
And you're able to get 12% return, right? Normally we don't buy at par, we'll buy close to par. And 12% is a good number. I know a lot of people are targeting a little bit higher,
Hmm.
13, 14. Would you ever sell any of your notes to someone else for say a 13 yield? Or because you could buy at 12, there's no point to.
Yeah, well, so it doesn't really on a long-term note, that kind of strategy makes sense because you're just looking at the discount that you have to, sell that note for, and maybe you're profitable in that seller finance note. And so, when you're doing that type of strategy, maybe you're discounting at a couple points and you're taking a 10% discount on your note value or something to be able to get to that higher rate in that case. On a 12-month interest only note, if I was to sell at 13, I'm just paying you money for originating the note, right? So it doesn't make sense on a short-term interest only loan type situation like that because and it usually a lot of times they pay off in 6 to 8 months because the
Yep.
rehab's done. And so that we just do 12-month notes like that and then we continue to do more and more of them and cycle them that way to make our spreads, right? And so
Yeah.
in that kind of situation, it doesn't. The only thing, and I've had this same conversation with a lot of guys like you guys that
Yeah.
existing paper because it's a totally different game than the short-term construction debt aspect. You're just looking at how do I make my interest rate spreads, protect my investors at all costs, and
Hmm.
make sure that I'm going to be profitable long term with the risk and how much risk I'm actually taking on that versus my profit, right? So
Yep.
because I always protect my investors, and whether I have a default or not, I'm paying my investors. So
Yeah.
and I'll just take over the property, go flip it, go do what I need to do. Every once in a while, I'll take a small haircut or something like that because I screwed up on a deal or something. But most of the time, if we do have to take it back, it's like a deed in lieu. They're communicating, they're having hard time, and
Gotcha.
I'm like, cool, we'll put up the rest, we'll go finish it and make our profits. And if you help us with the rehab, we'll even after we get our money back, we'll even give you a piece on the back end. And you try to be friendly with as many people as you can on that side. So.
Interesting.
So Sal asked the question, are you using DSCR loans? All business to business is DSR basically, right?
Mhm.
So yeah, there's no owner occupants here. He's doing either rehab loans or some kind of business to business loan.
Yeah,
Absolutely.
yeah,
B2B.
and we're
Yeah.
doing the rehab, the direct renovation loans on one side, and then if people want to come to us and refinance on the other side, we're doing the debt service coverage ratio loans for rental properties on that side. So if they want to refinance off of our 12% money into now 7.5% money, which you can probably get it down to like 6.75, but it's going to cost you like 3 points right now to do that.
Yep.
It's insane insane, and compared to what it was, at least, not
Yeah.
historically. But yeah, so that's usually what we're seeing right now, but it's at least better than 12% money. But it makes a rental property hard to cash flow. And so a lot of people
Yes.
are going to short-term rentals now for that strategy as well. They'll juice the cash flows a little bit. So
So with that being said, I know that you said, long term. Do you do anything longer than 12 months or it's not even worth it for you?
yeah, actually I do. So a lot of my single families that I have equity in, I seller finance consistently. I love doing the 5-10% down strategy to a homeowner and carrying paper. I usually do 5-year balloons or 7-year balloons as much as possible. Sometimes it depends on what the rate is. If I'm at like a 7% or 7.5 or 8% rate to a homeowner, I don't really want to hold that paper long term, but I'm looking at, okay, same thing, if I sold that as a discount to one of my private investors for 9 or 10 or something like that,
You're
and
paying
what am
off.
I netting out of that deal by doing seller financing on that strategy? And usually, many times, what I'll do is I'll just collateralize my paper at 75% of market value and then keep my equity in the rest. And if you look at the arbitrage on how much equity I have in my note versus the monthly payment that I'm receiving, I'm getting a great return on my money, on my cash flow. Usually it's 10, 12, 15, sometimes 30% on my
Yep.
money, depending on how much I'm into it for of my own capital, right? And my return on equity. So I do that quite a bit. I love that strategy too. It's great.
So if
So
Nathan and I wanted to buy your paper, would you, and it defaulted at any time, like you bought 12-month paper, how would you work it out that like that rehab has to be done? Me and Nathan don't want to do it. Do you kind of back up and say, listen, I'll buy it back from you? How do you structure
we
that?
we do all the work. So we come in and say,
Okay.
okay, hey, we're going to keep paying you typically. In that case, if it's a giant note or something like that, we'll
So you don't
we'll
want to
say up
sign the note
front.
over to us.
Yeah, so we
You
we would we would assign the note, and we still say that retain the servicing, and then we would just
okay.
make an agreement with you that says, hey, if you want us to foreclose on this property and pay the legal to foreclose, keep paying you your interest, and put up any excess rehab funds and go flip it, we'll do that because but we keep the profit on the back end. So and so but we'll keep paying you, and then we'll need an extension from you to be able to do that, if that's the case, if it's not, if it's been 12 months or something like that and they're not paying off. But that's the worst that usually would happen to one of my investors. None of my
Gotcha.
investors have ever lost money on any of my notes with me. So, and I have though, I've lost $1 million in the past, so you, once you're in the $1 million club, then great. But I had a contractor steal about a little over $500,000 on projects and gross negligence and fraud, like purposeful fraud, where they
American
doctored
Greed.
permits, they doctored receipts, fake
Does
pictures,
anyone
fake
see why we don't want to do this at
insane.
all? Like,
So yeah,
Yeah,
no, but this
smart
is the
about it.
risk of any of the flip
yep.
business. You know what I mean? Like any
Yes.
contractor could have stolen, but it cost me $1 million because we had to redo everything with the whole properties, on this, and because it was all fake. He drywalled walls up with no plumbing and electrical done just to show us, gave us fake permits of the plumbing and electrical and fake pictures of another property that had plumbing and electrical done. He put he put the 12-inch wall tiles that go in the shower, right? He put
Mhm.
wallpaper wall tiles up there were the squares like that looked like they were regular tile. I'm like, you literally went to that degree to defraud. It's insane. So, but this is what makes running a management company, running a lending company, dealing with contractors. I'm like, yeah, I'm a very optimistic guy, but everybody's a crook until I prove otherwise in due diligence. So,
Yeah.
but yeah.
Well, we did have some more questions. Nathan, do you have a question before I go to more questions here?
I'm just wondering if you're gonna be lending on just a regular mortgage, not a flip. Any states that you would not lend in?
Um, well, now Louisiana, because I think it's like an 8-month process to do this in. There's certain Illinois is another state, California
Yeah,
is another state. I really don't
yeah,
like tenant-friendly states. I want landlord-friendly states that I'm going to lend in that have, the smart business acumen. Even though I live in communism in California, I don't invest here. So and
I'm with you, Jersey here.
I'm like, where right on the Nevada border can I move that isn't just desert? you know? So I'm like, yeah, I got to go to Tahoe somewhere and up in that area. But
Yeah.
but yeah, they're definitely, we're really very aware of judicial foreclosure states after going through that process in the beginning. Sometimes they're judicial and non-judicial foreclosure states, and
Yep.
so sometimes certain states are just backed up. And, you should have seen the headaches that we had during COVID and stuff, just with recording documents, let alone
Mhm.
foreclosing on stuff. And, like
Tell us
during
about it.
that process, right? And so,
Yeah.
and of course, during our lending business, during that COVID market, we are like, teaching everybody how to go get their disaster relief loans and showing all of them, here's how you get your cash and go buy all your materials now so you don't have the supply chain disruptions, because it was taking weeks and weeks,
Oh my
if not
Lord.
months, to get appliances in.
Yep.
So and it's just
Yeah.
lost interest and lost money massively.
So there was a question regarding your balloon that he heard 5 to 7 years is a no. Um, and just for clarity, and stay tuned to the end. I do have a thing that I told Matt before that all note buyers should be aware. I haven't even told Nathan about this yet. So stay tuned to the end and make sure to remind me to tell you guys this. But from what I was talking to Max earlier, 5 years is the minimum that any balloon has to be past 5 years. So just be notice of the fact that 5 years for any owner occupant, the minimum is 5 years for a balloon. So
Yeah, that that
um,
that the Dodd-Frank stuff and all that kind of
yep,
stuff is obviously the most important thing in the world. So you don't, there hasn't been any real case law that I'm aware of on this that is really hard hitting on people, on this, at least according to Max and, some of
yeah,
our conversations with him. But
yeah.
at the end of the day, it's still, get your paperwork done, make sure it's done right. We're actually in the process right now of starting a mobile home debt fund to collateralize the seller finance debt on new mobile homes going into parks, backed by the park as well. But
That's a big one.
yeah, but the
That's a
Dodd,
big key,
yeah,
guys. Whoever buying mobile homes, the fact that the park will actually guarantee the payments, and if it defaults, the park will actually pay you the payments.
yeah, you do not want to take back mobile homes. So, you want
Yeah,
that park, and the financial strength of that park and the financial strength of and the experience of the operator becomes extremely important there as well. Who are you dealing with now as the guarantor for that? But what's interesting is we're able to structure really cool stuff. I mean, we're usually paying 12% to our investors in that type of structure. But that's, one other piece of debt that we're doing. We're also invalidating consumer credit card debt and getting legal fee receivables and collateralizing that at 25 cents on the receivable balance that has a historical collection ratio of 80% and making 30% over 18 months on our money and getting it paid back there. So this is why I love debt. There's like a million different ways. It's like, what's the collateral, who am I
yes.
dealing with, and what kind of rate can I make, what kind of
And
spread
what's
can I
default?
make?
What I do in a default duration?
Right. What do I have to do to take over if that's the case,
Yeah.
So, but
How
yeah.
much default are you seeing in the business you're in with all the fix and flips and whatnot? How much default? What ratio?
So it was in the beginning when I first got started, it had to be 10%, which sucked because we were doing it wrong to the wrong people and stuff like that.
What year was
Now
that again?
this was like 2007 or
Okay.
17 when I first started lending money. When I stopped needing capital, I'm going to networking events all the time. Like I run a nonprofit that teaches financial education and real estate education called For Investors by Investors in Southern California. And through that, I started gaining all the capital I needed for this, and I stopped needing it for my own deals. And so I started lending it to some of